Are you starting to learn trading and heard terms like stop loss, take profit, pip value, and don't even know what they actually mean? We are going to break down all of those terms in this video, continuing our series on basic trading terminology, so that you can finally understand what all of those things mean and how you can practically implement them in your trading. Let's start with the most hated word in trading, and that one is stop loss. A stop loss is an order you place on your trade to limit your potential losses on your position. This one works like a safety mechanism because it automatically closes your trade once the price has reached a certain level. For example, let's say you're trading Euro USD and you believe that the euro will strengthen against the US dollar. Thus, you enter a buy position. Your entry was at 1.17850, and to protect your capital, you limit your risk and you limit your losses up until price reaches 1.17800. So if price were to actually drop up to that point, your trade would be automatically closed, which is unfortunate for this trade, but at least it stops you from any further losses. The opposite of a stop loss, what every trader strives for, is a take profit. This one is also an automatic order, but in this case it will automatically close your trade at a winning position. For example, let's say you're in a buy at GBP USD and your entry position was at 1.35662. You set your profit to 1.35762. So if price goes up to that point, your trade will automatically close, booking in your profits. So except for stop loss and take profit, we also have something known as a trailing stop loss. This one is basically a moving stop loss. So this one doesn't stay fixed like a normal stop loss, but it's actually flexible and moves with your target. So let's say again you're going in with an entry position here and your stop loss is right below here. And price actually moves upper, but your stop loss doesn't stay fixed at that same level, but it moves along with your profits. So in this case, if your trade even gets stopped out later on, you will definitely minimize your losses and sometimes even be stopped out in profit. Of course, it's the exact same logic if you go in a sell position. We keep talking about price changes and price movements, but we never actually specified the amount of price movement. With normal currencies, you're probably used to dollars and cents. But in trading, we use even smaller units. And the standard unit we use in trading is the pip. And in many pairs, it's the 4th decimal place. For example, if Euro USD moves from 1.1785 to 1.1786, that's an exact 1 pip movement. A pipette is an even smaller unit than a pip, and it usually comes at the 5th decimal place. So for example, if Euro USD moves from 1.17856 to 1.17857, that is a 1 pipette movement. The pips and the pipette movements are the foundation of trading because we don't wait on huge price movements, but rather want to catch our profits in small price movements. We also use them to calculate our risk, our loss, our profit, and our exits. So now we have the pip, but how much is 1 pip worth? We get that value from the pip value. So the pip value tells you how much 1 pip is worth in money. And this one depends on your currency pair and of the size of your position. A simple way to calculate the pip size is usually by multiplying 0.0001 by the lot size and the contract size. In Forex, a standard lot is 100,000 units of the base currency, a mini lot is 10,000 units, and a micro lot is 1,000 units. For Euro USD, 1 pip on one standard lot equals $10, because the pair is quoted in US dollars. So if you trade one standard lot of Euro USD, every pip in your direction equals $10 of profit. Every pip in the opposite direction equals a $10 loss. Next on the list, we have support and resistance levels. And these are two terms which are used in most technical analyses, because support and resistance levels are usually two zones where traders expect the price to bounce back from. So when we talk about support, we talk about price support, and that is usually a zone where we expect buyers to come in and to prevent the price from falling below that support level. Similar to a resistance level, when the price reaches a resistance level, we expect the sellers to come in and to prevent the price from going any higher. For example, let's look at the Euro USD charts. We see that the price right now is at 1.17850, but we notice that the price continually bounces up and down from the two zones 1.17700 and 1.18000. So these will potentially be our support and resistance levels. If the price reaches the support, many traders might go in with a buy. If price reaches the resistance, many traders might go in with a sell. This is a good first indication, but of course these levels can change a lot during the day, during the week, or during the month. And there are zones stronger than others. Next we have the bull and the bear. That basically stands for the market sentiment. So the market which is bullish is a rising market. That means that you expect the base currency to strengthen against the quote currency. So the bull is trying to lift you up. The bear on the other side is trying to put you down. So in this case, we are expecting the market to be a falling one. That means that the base currency will weaken against the quote currency. Next on the list we have liquidity, and liquidity basically stands for how easily you can buy or sell a pair without causing any major change in price. Traders love liquidity, and the high liquid instrument usually has a faster execution and tighter spreads. And tighter spreads mean less cost, so it's always a favorable market. One of the most talked about examples in these videos is Euro-USD, because that's also one of the most liquid pairs traded, because many traders and institutions are constantly buying and selling it. That makes it easier to enter and exit trades at any given time. Some less liquid pairs, for example, would be the US dollar against the Czech koruna. These kinds of pairs tend to have a wider spread and be slower in execution, which also make them a little bit less favorable to trade. So right now we had liquidity telling us how much volume there is in the market, and now we have volatility telling us how much and how quickly the prices move. High volatility means that price can move abruptly and sharply in a very short period of time. For some traders it creates opportunity, for other traders it totally breaks structure. One pair known for volatility is Bitcoin, because its value can rise and fall a lot by just a couple of hours. On the other hand, the government bond usually has lower volatility, meaning that the price tends to move slowly and steadily. But this starts to go into the investment side of things. Traders usually prefer volatility because it gives them more opportunities. But it's only profitable if you have a tight risk management plan. Which brings us to hedging, because hedging is one of the risk management techniques where you open an opposite direction compared to the first trade that you initially go in. For example, let's say that you had a bigger position of Euro-USD open because you thought that the euro was going to strengthen against the US dollar. But in a short time frame, you might fear that the Euro-US dollar is going to come down a little bit. So even though you have that larger buy position, you might consider going in with a smaller short position just to minimize your potential losses. Because if your long trade makes losses, then your short trade will make profits. Of course, everything we do in trading is uncertainty, but it's speculating. And speculating basically means that you are taking a calculated risk based on where you think that the price will move. For example, if you might think that some OPEC announcement will cause the oil prices to rise, then you might start buying oil contracts waiting for that move to happen. So you are speculating on future price changes based on your current market outlook. Traders can do this over a longer period of time, but they can also do it over a shorter period of time, which brings us to scalping. Scalping is basically profiting from very small price movements, usually within a very short amount of time, a couple minutes to a couple hours. Where we see this most oftenly is during news releases. For example, you see or expect a pair to move rapidly up and down. A scalper in this case might go in and make use of that high volatility. But it's also quite a risky game, especially if you trade during news. Again, risk management is key. In the previous videos we talked about market orders and pending market orders, so immediate execution or future execution. But sometimes even though you enter a trade, you might get kicked into a position which is higher or lower than you expected, and this is what we call slippage. Slippage usually occurs during high volatile market moments, when we have very high trading volume, when prices move too quickly, and sometimes it even happens when we have low liquidity. How does that practically look like? Let's imagine you try to buy a stock CFD at $100. But right now there is an earnings announcement and the prices move too rapidly. So your order is not executed at $100 but at $101.5. The difference between where you expect it to be put in and where you were actually put in is what we exactly call slippage. While we're talking about market executions, it's important to talk about expert advisors, because those are automated trading programs that operate inside a trading platform. They can execute trades, apply technical indicators, and even manage your trades based on preset rules. For example, you might create an expert advisor for Euro-USD, and this one should use maybe some specific indicator for your entries. When those conditions are met, then your EA, your expert advisor, can automatically set in a trade for you. So it can automatically put buy or sell orders. The technical indicators we're talking about are tools that are used to analyze price charts. They're also there to support our trading decisions. Common examples include moving averages, MACD, and RSI. RSI, for example, stands for Relative Strength Index and is often used to identify overbought or oversold market conditions. So for example, if the RSI falls below 30, then the traders may consider that instrument is oversold and go in with a buy position. Similarly, when RSI moves above 70, some traders may see it as overbought and consider going in there with a sell position. But all of these terms bring us to the most important thing in trading, which is proper risk management. Because risk management includes all the methods that traders use to protect their capital. These can include everything from calculating your position size, to setting your limits, to putting your stop loss, your take profit, managing your exposure, and even diversifying trades or investments. And without proper risk management, even the best trading ideas can lead to losses. This wraps up the second part of our basic trading terminology series. Leave any thoughts in the comment section and hit the subscribe button to never miss any educational series from our side ever again. Thank you for watching, and I'll see you in the next one.
Hola Prime, trade with transparency.